What if you could own a slice of the Empire State Building or a portion of a mortgage-backed security? Well, that's essentially what real estate investment trusts, or REITs, offer. But not all REITs are created equal. Ever puzzled over the differences between mortgage REITs and equity REITs? Well, today we're diving into these two distinct types of REITs. Consider equity REITs, the more common of the two. They function much like landlords. They own and manage income-producing real estate. Think office buildings, shopping centers, apartments, and hotels. A prime example is Simon Property Group, a global leader in retail real estate ownership that boasts a portfolio of malls and premium outlets. Equity REITs generate income primarily through collecting rent from tenants. Now let's shift our focus to mortgage REITs or MREITs. They act more like bankers. They don't own real estate directly. Instead, they finance real estate, earning income from the interest on their investments in mortgages or mortgage-backed securities. Take Annaly Capital Management, for instance, a leading MREIT that invests in and finances residential and commercial assets. These two types of REITs don't just differ in what they invest in and how they generate income, they also react differently to economic conditions. Equity REITs are heavily influenced by the health of the property market. If commercial rents are rising and property values are appreciating, equity REITs tend to perform well. On the other hand, MREITs are acutely sensitive to interest rate changes. When interest rates rise, the cost of borrowing increases, squeezing their profit margins. Conversely, when rates fall, MREITs often see their income rise. In terms of risk and return, equity REITs and mortgage REITs exhibit distinct profiles. Equity REITs generally offer more stable, albeit lower returns. This is because rental income tends to be more predictable, but they're not immune to risk. Property values can fall, and tenants can default. Mortgage REITs, meanwhile, can offer higher potential returns, thanks to the leverage they employ. But with higher returns come higher risks. Interest rate volatility can significantly impact their earnings, and if borrowers default on their loans, MREITs could take a hit. Then there's the matter of tax. Both types of REITs are required by law to distribute at least 90% of their taxable income to shareholders as dividends. This requirement allows them to avoid paying corporate income tax. But remember, those dividends are usually taxable for investors. In essence, equity REITs and mortgage REITs provide unique ways to invest in the real estate sector, each with its own set of risks and rewards. Whether one is right for you depends on your investment goals, risk tolerance, and economic outlook. But understanding the differences is a great first step in making an informed decision. So the next time you think about investing in the real estate market, remember you have options. You could be a virtual landlord with an equity REIT or a virtual banker with a mortgage REIT. The choice is yours.